Welcome to this presentation titled From A to Z Level 1, your practical guide to FX and CFDs at FXCM. Before we get into the presentation itself, I'm going to bring up this disclaimer. I'll give you a few seconds to have a read through that and then we'll continue. Thank you very much for that. Now, the information contained within this presentation is must-know information. This is the syllabus that we'll be covering in this presentation. I'm going to give you a few moments to have a read through this, and then we'll continue with our introduction to Forex. Thank you very much. Okay, introduction to Forex. The Forex or FX market is a decentralized market. It is the largest market in the world and has a daily volume that's in excess of $5.3 trillion. There are a number of advantages to trading Forex. First of all, it is a 24-hour market and it is open 5.5 days a week, from Monday morning in New Zealand all the way through to Friday 5 p.m. New York time. You're able to go long or short. There are no limitations to shorten currencies. It is also a leveraged market. You can get leverage of up to 400 to 1, which allows the trader to take advantage of even the smallest move. However, please note that leverage is a double-edged sword, as it will amplify your profits when you're on the right side of the market, but it will amplify your losses as well when you're on the wrong side of the market. Another advantage is that it is a low-cost market. Forex accounts trade without commission and expensive exchange fees or data licenses. The cost is the spread between the buy price and the sell price, which is always displayed on your platform. Introduction to CFDs. A financial contract for difference, or CFD, is when a buyer pays the difference in the value of a security at the beginning and end of a stated period. CFDs are derivatives that allow speculation on the price movements on an instrument. The buyer and sellers of CFDs agree on the current value of an instrument and then the value at the end of the contract, where money will be paid to either the buyer or the seller. It is a contract between a buyer and a broker or other selling institution to exchange the difference between the purchase price on the contract and the price at which it is sold. Buying or selling a CFD serves as a proxy for buying or selling an underlying asset without the need to actually exchange the asset. CFDs can involve long or short trades. In a long CFD trade, a trader enters a contract to buy with the hope that the price of the underlying asset will rise. In a short CFD trade, a trader enters a contract to sell with the hope that the price of the underlying asset will fall. Forex, indices, and commodities. Contracts for difference, CFDs, and Forex have important similarities and differences that traders should be aware of. CFDs are derivatives that allow speculation on the price movements of an instrument. Both can be quite helpful for the purpose of speculation, and by learning more about the two, investors can decide which one best suits their objectives. In some cases, traders may opt to use both. It really depends on the situation. CFDs can be used to speculate on the FX market and used to trade commodities, indices, and assets such as oil. Both CFDs and Forex trading avoid the transfer of physical assets. They in fact both trade over the counter, meaning that their transactions are decentralized and take place through a network of financial institutions. The trades are also typically executed in the same way. And while CFDs and Forex do have many similarities, they also have key differences. For example, some CFDs have expiry dates. By knowing these differences, investors can make better informed decisions on how to incorporate CFDs and Forex into their trading strategy. The spread. In Forex, the currency pair is expressed at both an ask or buy price and at a bid or sell price, and the difference between the two is called the spread. With CFDs, the spread is also the difference between the buy and the sell price. However, unlike foreign exchange that can have negative spreads, all CFDs have minimum spreads. Now, FXM will display the spread in their pricing. So if you take a look here, we have the euro US dollar and the spread is 2.5 pips. What is a pip in Forex trading? A pip is the smallest movement an exchange rate can make. For most currencies, a pip can be considered as 1 unit of the fourth decimal point. However, in the case of the yen, it is 1 unit of the second decimal point. So for example, if the price of euro US dollar changes from 1.2300 to 1.2301, that will be an increase of 1 pip. Pip is very important in determining the overall cost, profit, and loss that can be generated by a trade. A trader needs to calculate how much a pip will be worth for a given currency pair and will depend on the size of currency lots being traded. For example, if you place a buy trade on euro US dollar with a trade size of 1 standard lot, which is 100,000 units, the pip value will be $10 if your account is denominated in dollars. So if the euro US dollar increases by 50 pips, you will gain $500. That's the 50 pips times the $10 per pip. What is a pip in CFD trading? Well, each pip for a CFD will represent 0.10 of that instrument's counter currency. The exceptions are gold and silver, which are both 1 cent per pip, Hong Kong 33, which is 1 Hong Kong dollar per pip, and Japanese 225, that is 1 Japanese yen per pip. Now, the counter currency on a stock index is the currency associated with that exchange. For example, the US 30 will be US dollars, the German 30 will be euro, the UK 100 will be the Great British pound, and the Hong Kong 33 will be a Hong Kong dollar. As profit and loss is converted into the account currency, a pip cost is associated with each product. The pip cost is displayed on FXCM's Trading Station 2 and shows the cost per point for the minimum contract size in that account's base currency. Lot size. Currencies are traded in standard lots, mini lots, and micro lots. Standard lots are the largest trading blocks, measured in 100,000 units of a given currency. A standard lot of British pounds, for example, would be 100,000 pounds. A mini lot is equal to 10,000 units of a currency, so 1 mini lot of euros would be 10,000 euros. And a micro lot is equal to 1,000 units of a currency, so 1 micro lot of US dollars would be 1,000 US dollars. Take a look here. 1K or 1,000 equals 1 micro lot. 10K or 10,000 units equals 1 mini lot. 100K or 100,000 units equals 1 standard lot. There are differences between FXCM's TS2 and MT4 platforms. So, given the lot size of 1 microlot or 1,000 units, in TS2 it's 1K and in MT4 it's 0.01. A mini lot, which equals 10,000 units, in TS2 will be 10K and in MT4 0.1. And a standard lot, which is 100,000 units, will be 100K in TS2 and 1 in MT4. Margin. Margin for trading in capital markets is related to investment capital that is available to traders before they carry out trades of securities and other assets. Margin can be thought of as a good faith deposit required to maintain open positions. It is not a fee or a transaction cost. It is simply a portion of your account equity set aside and allocated as a margin deposit. Margin requirements per 1K lot for FX and 1 contract for CFDs are determined by taking a percentage of the notional trade size plus a small cushion. A cushion is added to help alleviate daily or weekly fluctuations. Used margin is how much money you have set aside to secure your open trades. Usable margin is money left in your account to open new trades or to absorb losses. Always make sure that you have plenty of usable margin, otherwise you may get a margin call. If your usable margin gets low, you should close some trades or deposit money into your account. Trading on margin is a common attraction to the Forex market. It allows you to open trades that are larger than the capital in your account. Leverage. Leverage relates to the amount of leverage that your account is using to control the total value of the positions you have open. Consider this example. Assume that you have a standard lot in US dollar, Canadian dollar, which is worth $100,000. Now, if your account size is $20,000, we have a situation where effectively the $20,000 is controlling $100,000, and that the effective leverage is $100,000 divided by $20,000, or 5 times, or 5 to 1. Here's another example. Let's assume that we have 2 standard lots open of US dollar, Canadian dollar, which is worth $200,000. Again, assume the account size is $20,000. So here we have the $20,000 account controlling a $200,000 position, and the effective leverage is 200,000 divided by 20,000, which equals 10 times, or 10 to 1. A 400 to 1 leverage allows each $1 in your equity to control 400 US dollars in a trading position. The relationship between margin and leverage. Margin is a good faith deposit required to keep a trade open. Leverage is a byproduct of margin and allows an individual to control larger trade sizes. Leverage and margin refer to the same concept, just from a slightly different angle. When a trader opens a position, they are required to put up a fraction of that position's value in good faith. In this case, the trader is said to be leveraged. The amount that is required to be put up is known as the margin requirement. Now, given a margin ratio of 100 to 1, a trader would need to only put up $100 to control 10,000 units, which is 1 money lot. Therefore, having a leverage of 100 to 1 means that your margin requirement is 1% of the value of the trade. Leverage equals 1 divided by margin. Therefore, 400 to 1 equals a required 0.25% margin. 200 to 1 equals a required 0.5% margin. 100 to 1 equals a required 1% margin. And 50 to 1 requires a 2% margin. The correlation. How do I calculate the lot size? Okay, well, when choosing the lot size for your trade, you may want to consider a few factors. The price levels or number of pips that you want to set your stop and limit orders to, the amount of capital you wish to risk, and the amount of usable margin that you have available to open new trades. The lot size will have a direct impact on your pip cost and your equity. Based on the lot size, the pip cost will be determined. So let's take a look at an example. Assume you have $10,000 in your FXCM account and the margin is 1%. That is a leverage ratio to 1. Now assume that a trade of 1 standard lot, or 100,000 units of the US dollar, Canadian dollar, is entered into. The used margin will be $1,000. That is 10% of your equity, but that is equitable to a 1% margin, 1% of the total trade of 100,000 units, right? The usable margin is equity minus that used margin, which is your $10,000 in your trading account minus the $1,000 that has been allocated to margin, leaving you a usable margin of $9,000. Now, because you are using 10% of your equity, the pip cost is actually going to be 10 Canadian dollars. But because your account is denominated in US dollars, you should convert the 10 Canadian dollars to US dollars. And in this example, we're assuming that the exchange rate is 1.2650, which equates to 7.9 US dollars. Let's take a look at a second example. So in this example, we are assuming you choose to trade 5 standard lots, or 500,000 units of US dollar Canadian. Now, in this case, the used margin is $5,000 or 50% of the equity in your trading account. But it's still only 1% margin because it's 1% of the total 500,000 units. Now, the usable margin there is the equity, which is $10,000, minus the used margin, which is $5,000, which leaves $5,000 in your account. Now, the pip cost here is going to be 50 Canadian dollars because you have essentially used 50% of the equity in your account. Now, that is equivalent to $39.50, and that's American dollars. And again, we're assuming that the US dollar Canadian dollar exchange rate is 1.2650. We recommend not to use more than 10% of your equity to open trades. In other words, only use a leverage of 10 to 1. Using a higher ratio will increase your risk per trade. Rollover. Rollovers are also sometimes referred to as swaps or the swap rate, and it's the interest paid or earned from holding a position overnight. Any client holding a position at the end of the trading day, which is 5 p.m. New York time, will be credited or debited a rollover. To avoid the rollover, you can close your position anytime before the 5 p.m. New York time, and the charge will not apply. Take a look at this table. The last two columns show the rollover. Roll S is if you're going short, and roll B is if you've gone long. Now, the first row shows the euro-US dollar. And if you short the euro-US dollar, you actually will be earning a rollover of 0.0497. And if you are long, you will actually be incurring a rollover cost of 0.1038. And you can go through all the rows and you'll see each instrument has a rollover associated with it, depending if you are long or short. Now let's take a look at the rollover specifically with regards to Forex. Each currency has an overnight interest rate associated with it, and because Forex is traded in pairs, every trade involves not only two different currencies, but they're two different interest rates as well. Typically, if the interest rate on the currency you bought is higher than the interest rate of the currency you sold, then you will earn rollover, which is called a positive roll. Conversely, if the interest rate on the currency you bought is lower than the interest rate on the currency you sold, then you will pay a rollover, which is called a negative roll. Most liquidity providers are closed on Saturdays and Sundays, so there's no rollover charge for these days. However, the liquidity providers still apply interest for those 2 days. To account for this, they generally will book 3 days of rollover on a Wednesday, which makes a typical Wednesday rollover 3 times the amount that was on the Tuesday. Additionally, there is no rollover on holidays, but an extra day's worth of rollover is applied 2 business days before the holiday. Let's consider the rollover for CFDs. CFDs also incur a rollover. However, on Fridays, to account for holding the position over the weekend, the rollover is 3 times the norm. To avoid the rollover, you can close your position before 5 p.m. New York time and the charge will not apply. Transaction costs. Let's take a look at transaction costs with Forex first. With FXM, you pay only the spread to trade Forex, so there's no commissions down the road. With spread-only trading, your platform calculates your transaction costs automatically using this formula. The spread times the pip cost times your lot size equals your total cost. With CFDs, it's very similar. The formula is the spread times the pip cost times the contract size equals the total cost. Please note, commission-based pricing is available on active trader account types. Commissions are charged at the open and close of trades in the denomination of the account. Margin call. If a trader's losses exceed the amount required in their margin account, they will be notified to deposit more money into the account to bring it up to a required maintenance balance. If they don't deposit money, FXM has the right to liquidate any securities or other assets held in their client's trading account to cover the losses. In order to try to avoid extreme losses, traders will often use trading strategies that include stop losses and limit orders in their trade exit planning. Margin calls generally occur due to over leveraging. Using more leverage can increase your gains, but it can also increase your losses, which will quickly deplete your usable margin. The more leverage that you use, the faster your losses will accumulate. In TS2, margin calls are triggered when your usable margin falls below zero. This occurs when your floating losses reduce your account equity to a level that is less than your margin requirement. A margin call may result in liquidation of all positions unless otherwise specified. In MT4, margin calls are triggered when your free margin is equal to or less than zero. Trades are closed in order of the size of their loss, from the largest loss to the smallest loss. This is recorded in the profit column at the time of the margin call. Please note that the Level 2 guide will discuss margin calls in more detail and how they may be avoided. Conclusion. To summarize all the above, in order to avoid a margin call, you should be careful with your trade size. It should be based on your equity and you should not use a leverage more than 10 to 1. This means that if you open an account with $10,000, your total open positions should not be larger than $100,000. Your trade size will impact your pip cost, usable margin, used margin, and of course the potential of the trade to being a success. FXCM apps created a risk calculator which helps you determine a lot size to trade based on the parameters above. The risk management indicator is here to help. Once you set your preferred risk percentage, this intuitive indicator calculates a position size for your trade, recommends stop and limit distances, and calculates the total value gained or lost should the stop and limit execute at their set parameters. The three types of analysis. 1. Fundamental analysis. Fundamental analysis in the Forex market is the analysis of the economics of a country. Fundamental analysis gives information on how the currency market is impacted by major political and economic events. Key factors to look out for include interest rates, GDP, CPI, and the jobless rate. A pivotal factor in fundamental analysis includes the role of the central bank. The central bank typically looks to control inflation, to maintain average currency exchange rates, maintain economic stability, reduce unemployment, and control interest rates. Interest rates and important economic terms. Interest rates are the main tool used by central banks to address the economy. Any change in interest rates from a central bank is considered as one of the most important factors affecting the Forex market and can cause large fluctuations in the market. Higher interest rates are used when central banks aim to slow the economy to curb and cool down inflation. Higher interest rates reduce investment and curtail large purchases in homes, cars, and boats. Low interest rates are used when central banks aim to encourage further growth, as in the case of contraction. Low interest rates encourage investment where investors seek to buy long-term purchases such as cars and homes as they become less expensive. Consumer Price Index, or CPI, is an indicator to measure inflation and is sometimes seen as an indicator of the effectiveness of government policies. It tracks changes made in the price of a basket of goods and services that may be purchased by a typical family in a particular country. The increase in the index indicates that the individual pays more in order to buy the same set of basic consumer items. Gross domestic product, or GDP, this is the total monetary value of all goods and services produced within a country. It is measured by comparison to the previous quarter of the year or to the previous year itself. Gross domestic product is considered very important for each country as it reflects the health of the country's economy and also has a significant impact on individuals, the stock market, and currency markets. The jobless or unemployment rate. Unemployment has many negative effects on the economy, including a decrease in personal consumption, a decline in production, and reduced demand for products and consumer goods. This usually leads into a decline of GDP. Moreover, the government may need to increase its borrowings due to lower tax revenues. Keep a lookout for FXCM's economic calendar, which helps keep track of daily economic news releases. The FXCM News app, an easy way to stay connected to your platform and to track all economic events directly on your charts, is through our free FXCM News app. This app will allow you to add on plots onto charts directly from the economic calendar. Both past and upcoming news releases appear on the corresponding candlestick. Hover the mouse pointer over each candlestick for information on the previous, forecasted, and actual data for each economic news release. All instruments, select No to only show news events pertaining to the currency pair on the chart. Select Yes to show news events for every available currency pair. Filter the news by importance. Select the importance of which news events show on the chart. You can also refresh news automatically. Select the options of yes or no, and minutes between news refresh. Enter a value for how often news is refreshed automatically. Number 2, technical analysis. In this section, we're going to be looking at charts. And in this slide, you can see we're going to be looking at the candlestick chart. Many traders prefer candlestick charts because they are visually appealing and provide substantial information in a small amount of space. If investors can successfully use them to interpret market sentiment, they will have one more tool that they can use to determine whether to enter or exit a trade. Take a look here. You can see we have a blue candlestick. Now, the real body represents the difference between the closing price and the opening price. Because the color of this candlestick is blue, it means that the closing price is higher than the opening price. We also have shadows on either side of the real body, which represents the high price for the period and the low price for the period. In the next slide, we have a red candlestick. Again, the real body represents the difference between the closing price and the opening price. However, because it is red, it means that the closing price is lower than the opening price. Again, we still have the upper shadows and the lower shadows, which are indicative of the high and the low for the period. Now, what is technical analysis? Well, technical analysis is the practice of anticipating price changes of a financial instrument at any financial market as a whole by analyzing prior price changes and looking for patterns and relationships in price history. It is the art of gauging the trends, momentum, and the overall sentiment behind the price movement of a stock or any other security, helping us to make the investment decision. In technical analysis, there are hundreds of indicators that are used, compared, screened, and then applied as a part of an underlying investment strategy. However, it is interesting to note that no single indicator has ever been found to be accurate 100% of the time. Now, here are the main differences between technical and fundamental analysis. Firstly, with fundamental analysis, it's a method of forecasting the future price based on strength of business and economic factors. In technical analysis, it is a method of predicting price movements by studying charts of past market action. Fundamental analysis focuses on demand and supply, seasonal cycles, financial health, government policies, long-term goals of investors. Technical analysis focuses on price, volume, open interest, which is particular to the futures market only, and short to long-term goals of investors. Chart elements and volume. The price chart is a sequence of prices plotted over a specific time frame. In statistical terms, charts are referred to as time series plots. Now, on the chart, the vertical axis will represent the price scale and the horizontal axis will represent the time scale. Volume is simply the number of shares or contracts that trade over a given period of time. FXCM offers a number of volume tools to its clients. Real volume by price, which is shown in the figure here, volume profile indicator, market depth, and on-balance volume. Trend lines and the use of trend. Trend is really nothing more than the general direction in which a market is headed. Prices tend to move in a series of highs and lows over time, and in technical analysis, it is the overall direction of these highs and lows that constitute a trend. An uptrend is classified as a series of higher highs and higher lows, while a downtrend consists of lower lows and lower highs. Here is an example of an uptrend. Each of the high points of the trend, points 2, 4, and 6, are higher than the previous high, while each of the low points of the trend, points 3 and 5, are higher than the previous low. For the uptrend to continue, the next low point must be above 5 and the next high point must be above 6. If not, the trend is in danger of reversing. Now, there are three types of trends. There's an uptrend, a downtrend, or a sideways or horizontal trend. The importance of trend. It is important to identify and understand trends so that you can trade with them rather than against them. Two important sayings in technical analysis are: the trend is your friend and don't buck the trend, illustrating how important trend analysis is for technical traders. Channels. A channel consists of two trend lines that act as strong areas of support and resistance, with a price bouncing around between them. The upper trend line consists of a series of highs, while the lower trend line consists of a series of lows. A channel can slope upwards, downward, or sideways, but regardless of the direction, the interpretation is always the same. Traders expect the price to trade between the support and resistance of the trend lines until it breaks out of the channel, in which case traders can expect a sharp move in the direction of the breakout. Support and resistance lines. Support is the price level where the buying pressure exceeds the selling pressure. This creates an excess demand and pushes price up from the support level. Resistance. This is the price level where the selling pressure exceeds the buying pressure. It creates an excess supply and pushes price down from the resistance level. Relative Strength Index, or RSI. The RSI is a technical indicator and it is used to determine the direction and momentum of an instrument. It also clarifies whether the market is overbought or oversold. If the RSI is above 70, the market is considered overbought. If the RSI is below 30, the market is considered oversold. And if it is at 50, the market is considered balanced for the time period that you have chosen. Moving average. A moving average is used to smooth the changes in the prices of financial assets, and this eliminates the small fluctuations in the prices. Moving averages are used to determine the direction of the asset on a short-term basis, medium-term, or even a long-term basis. And there are different types of moving average. The most commonly used are the simple moving average and the exponential moving average. Moving average convergence divergence, or MACD. The MACD indicator is one of the most common indicators among traders. It measures the relationship between two moving averages. It is the difference between the 12-period EMA and the 26-period EMA. When the MACD crosses above its signal line, it is considered a buy signal. And when the MACD crosses below the signal line, it is considered a sell signal. Our exclusive market scanner. With FXCM's market scanner, you get a quick way to screen Forex and CFDs using the technical parameters you like best. Choose your preferred indicators and time frame and scan. It'll give you the 5 strongest signals. FXCM's market scanner is a tool designed to identify potential buying and selling opportunities by scanning the market with a suite of traditional technical indicators. Select the symbols, time frame, and indicators that you want for your scan. With symbols, choose Forex or CFDs or all. Time frames, short term, 15 minutes, medium term, 1 hour, or long term, 1 day. And from the indicator list, choose the ones you want. To name a few, 200-day exponential moving average, 30-hour exponential moving average, MACD, RSI, stochastics, CCI, SSI. Strong weak application. If you're looking for an app to save you time, Strong Weak is your new best friend. The Strong Weak standalone app provides an easy-to-read interface showing the strongest and weakest major currency movers. What used to require hours of chart analysis can now be easily and visually displayed in a matter of seconds, so you can make quick decisions on trading trends. Strong Weak aggregates movements, the gains and the losses of a base currency against all other major currencies. So, for example, if the euro-US dollar rose 50 pips yesterday, then the euro reads plus 50 and the US dollar reads minus 50. This is calculated across all major pairs. The app also shows the absolute strongest and weakest currencies for 4 time frames, the 15-minute, the 1 hour, the 4 hour, and the daily. Strong Weak costs $99, but open a real account with FXCM and get this app for free. If you already have a real account, then please reach out to your financial services representative. 3. Sentiment analysis. The Speculative Sentiment Index, or SSI. The Speculative Sentiment Index is a proprietary tool offered by FXCM. The SSI analyzes current data and is considered a leading indicator, meaning it can often signal a change in market direction before that change happens. The SSI focuses on buyers and sellers, comparing how many are active in the market and produces a ratio to indicate how traders are behaving in relation to a particular currency pair at any given time. A positive ratio indicates more buyers are in the market than sellers, whilst a negative ratio indicates that more sellers are in the market. The SSI is considered to be a contrarian indicator, which means traders may want to trade in the opposite direction that the indicator is pointing. Thus, if the index is showing that there are more buyers in the market than sellers, it could be taken as a signal that the market is in an overbought condition and that there may be pressure to sell. Similarly, if the SSI is showing that there are more sellers in the market than buyers, this may hint that the market is in an oversold condition and that the moment could be favorable for buying. Backtesting and strategy optimization. Backtesting, the best way to test a system without risks. Evaluate the performance of your automated trading systems in a few minutes with no risk. Make a realistic test personalizing the parameters of your account before the test. You can select account balance, leverage profile, and base currency. Have access to our large market data that includes years of market rates over dozens of financial instruments. Customize your automated strategy parameters and look for the best combination before applying your strategy on your real account. Receive a complete statistical report that includes key information related to risk management, percent of profitable and non-profitable trades, drawdown, and trading parameters. Have the ability to activate advanced parameters like slippage and gaps to include liquidity fluctuations on the backtesting process. You will be able to backtest any of our 5 automated strategies already included on our Trading Station 2 platform, or you can download additional ones from www.fxcmapps.com. Optimizer, your automated strategy refined. One of the best ways to improve the parameters of an automated strategy in a single platform is using one of the most advanced tools that Trading Station has to offer, your strategy optimizer. Make significant changes to the parameters of your automated strategies with no effort and with just a few clicks. Have access to our large market data that includes years of market rates over tens of financial instruments. Have access to customize your automated strategy parameters and to combine them dozens of times simultaneously to look for the best combination before trading. Receive a complete statistical report that includes key performance indicators simultaneously with different parameters combinations to compare them and select the best alternative based on your preference. You will have access to activate advanced parameters like slippage and gaps to include liquidity fluctuations on the optimization process. And you can optimize any of our 5 automated strategies already included on our Trading Station 2 platform, or you can download additional ones from www.fxcmapps.com. Simulation mode, years of testing in an instant. This advanced tool, already included in the Trading Station, offers you the ability to replay the markets at super speeds in just a few minutes. To get you started, you only need to select the simulation mode and the date from which you would like to start the market's replay. The platform will show you the market's data from that date moving forward. You'll be able to trade manually or test your strategy, control the speed of the price update, and simulate hours of trading in just minutes. You can get the speed data 100 times faster than normal. This is one of the most efficient ways to test your strategy for a long time in a short period. Test your strategy for 3 months, make adjustments, and retest another 3 months, all in just a few minutes. Have access to our large market data and select the financial instruments that you prefer. Save your simulation projects to review them later. Alternate your strategy and increase your success probabilities. You can use any technical indicator on the simulation mode and replicate any market scenario from the past, be it non-farm payrolls, Federal Open Market Committee meetings, or interest rate releases. Please take a look at this disclaimer with regards to the hypothetical simulated performance. I'll give you a few minutes and then we'll go on to our last slide, the very last slide for our level 1 presentation. Okay, thank you very much for that. Now for our last slide. In order to deeply understand backtesting and strategy optimization, please do not hesitate to reach out to one of our expert representatives. Thank you very much.